Well, hello, good evening, welcome. Martin North here from Digital Finance Analytics. Great to have you on the channel for another Tuesday evening conversation. No guest tonight, it's just me, but I've got a lot of information to share with you. Actually, I did have a thought, maybe I wouldn't bother to share any information, I'll just have a hang out with the dogs, but I thought that probably wouldn't last that long. Seeing as at the moment the dogs are, well, pretty much flat out, so there's not much to see there. So what we're going to do is go through some of the latest data. I'll take some questions, of course, from the chat as we go. And there's a lot to talk about because there's a few moving parts about, if I'm honest. So let me just sort this out and make sure that I can get the right information up. Right. So as normal with this particular conversation, I will just remind you about the house rules, simply because, of course, it's pretty important that we actually do have everybody on song. We don't provide financial advice or legal advice on the channel. This is a general conversation only. Please play nice in the chat room. We do moderate the stream, and obviously we like people to be polite, so please do that. This is as at the 8th of June if you're watching in a replay. And if you'd like to get my attention, there's always a lot going on in the chat, and I do encourage everybody to have some really good conversations. But if you want to ask me a question or to get my attention, if you use @WalkTheWorld, that then goes into a different queue, and it's make sure that I can see it. Super Chat's enabled, and if you'd like to get your question top of the list, you can use Super Chat or indeed make a contribution to what we do here. And thanks already, a couple of people have made contributions which are greatly received and help cover some of the costs of what we do here. Now, before I get on to the stress and household situation, I just wanted to cover a few broader slides because there's so much going on. And this was a really interesting one that came out literally in the last few hours. Moody's downgrades US banks and warns of possible cuts to others. I think this is quite significant because essentially there are a number of regional banks now that Moody have downgraded. And I wouldn't be surprised, frankly, to see a few more later. I've said quite some time. Steve, you're right, 8th of August. Oops, what happened there? Yeah. We're in the time loop. Don't tell anybody. It is the 8th of August. Yeah, so Moody's have downgraded, and that's a significant issue, I think, with regard to what we may see. I think we may see more of these. I've said for quite some time that there are several hundred regional banks in the US that might be in some difficulty. Another piece of information which came out today was that Italy surprises with a tax on the banks, extra profits. So they're going to put a levy on the banks which will go towards financing tax cuts and to support mortgages, particularly for first-time owners. That's put a significant dent in stocks in Italy at the moment and also shifted the bond market. So I think that's quite an interesting observation as to what's going on. Here's another one. China's trade plunges more than forecast to blow to recovery, and you can see there that the exports have fallen again. That means, of course, that input demand probably is going to be also under question, and that could have an impact on Australia as well. Now, coming back to local news, Lendy said that in a research, only 21% of mortgage holders in Australia still benefit from pandemic-era low interest rates, and that there were different distributions across the states, with 22% in New South Wales, Queensland at 22%, and the Northern Territory 20%. And interestingly, they said that roughly 65% were couples or families, and they'll suffer a jump in repayments once the new rates have come through. And that's coming through in my data, as I'll show in a second. Another one here is the interbank rate. And interestingly, the markets are now saying that rates will go higher, but not as high as previously expected. But even a year plus into the future, rates are going to be where they are or higher. So it is very significant. And also the Roy Morgan data came out again. This is the consumer confidence data, and they showed that once again confidence fell. And they said among the housing cohorts, confidence fell to a record low for those renting. It did improve for those paying off their home, but it remained below 70. one of the reasons why it probably improved slightly is that we've seen a number of households who've been able to refinance and find a bit of wriggle room, but not everybody, of course. Also, a piece of research from ANZ said that price indicators lifted sharply in NAB's July business survey. Strong rise in selling costs and retail prices, suggesting businesses are continuing to pass on higher costs to households. In other words, more inflation is in the pipeline potentially. And interestingly, the jobs ads rates moved up slightly, but are still much lower than they were previously. And of course, the unemployment rate is still relatively low at the moment. So bearing in mind the Reserve Bank was talking about seeing a rise in unemployment, that's an interesting observation as to where we are. Another one is this one. This came out today from the ABS showing the discretionary and non-discretionary spending. And non-discretionary spending has dropped again. That's because people are basically hunkering down and spending more on things they have to spend, including food. And they also showed some variations across the states, with New South Wales and Victoria showing a significant fall, but WA actually showing the biggest fall relative to April 2022, followed by the ACT. So there's some interesting indicators here that suggest the economy is wobbling towards a recession, in my view. Here's now another one, of course. This is the data from CoreLogic, and just showed that the property prices that were bubbling up are bubbling sideways or down in some cases. Sydney's maybe turning the corner again, not surprising given what we've seen going on. And they provided some more specific information with regard to the distribution of prices. So significant rises, of course, post-COVID, then a fall, and then a bit of a rise. But now maybe that's turning again. We'll wait and see. I suspect prices will continue to fall, as you'll see in my notes later on. Also, it's worth comparing the combined capitals with the regionals. Regionals have hardly moved up 1.2%, capitals up 3.5%, and in some regional areas prices continue to drift lower rather than up. And this is the complete summary, which shows you the past month, the past 3 months, and the past 12 months. And you can see that there's some very big stories in terms of variations. And I'd highlight the fact that regional Victoria is down over the past month. Regional New South Wales is flat. And if you look over the last 3 months, then you'll see that regional Victoria was down as well. Listings, of course, continue to track lower. This is the combined 28-day count of the capitals, and you can see compared with the last 2 years. And of course, Edwin and I have been talking about this for some time, suggesting that one of the reasons why prices are supported is the lack of listings, although there are some subtle changes now with the listings that are going on. And if you look at the next slide here, you can see that there was a little bit of an uptick earlier than perhaps people expected. It's a bit unusual to see these listings come up, and in fact in my surveys some of those listings are due to the number of property investors who are now selling again. And interestingly, that we are seeing that some property investors are just not able to make the returns on the significant momentum that they had previously. Prices moved up, but they couldn't then necessarily put the rents up sufficiently to cover the mortgage costs that are there now. And if we go on and look at the next one, this is the changes in rents. So you can see that rents are still a bit all over the place. The annual changes are very strong, with Sydney at 17.8% and Perth at 15.9%. Over the last little time for houses, not quite the same movements up. So a lot of people actually move from houses to units to try and find somewhere to live. But I'd highlight here that Canberra is showing a fall in rents for both houses and units, and we'll see that in some of the mortgage stress data shortly. That's quite a big deal. The vacancy rates are still pretty low, with the combined capitals at 1.2 and the regionals 1.6, and certainly way lower than where we've seen over the last 10 years from an average point of view. Interesting report came out showing that there's a significant housing shortfall in New South Wales. There's a demand of something like 314,000. That means you need to build 62,000 each year. The number of new dwellings completed in the year to December 2022 was 46,000. And the number forecast to be built over the next 5 years is 180,000. So there's a shortfall. And there was some quite interesting research published by E64 that showed the net domestic population movements, with, of course, people moving away from Melbourne and Sydney towards Brisbane and some towards Perth. And interestingly, they also showed that it was younger people, the 20s, the 30s and the 40s, who were leaving Sydney. And that's from 2016 to 21. And that's to do with housing affordability. It's one of the main reasons that I see people moving in my surveys. And interestingly, where do Sydney leavers go? Well, according to this research, the answer is they go out into the regions, so the mid-north coast, the Hunter Valley, Shoalhaven, or Canberra, or to Queensland. And we've seen a significant spike in migration to the Sunshine Coast, the inner city areas of Brisbane and the Gold Coast over the last couple of years. Although I noticed recently that some of those who bought then have now sold again. So that's quite an interesting observation. So that's giving a little bit of context for our conversation. And what I'm going to do now is I'm going to just go through some of the mortgage stress data. Now, I did do a show on this, the high level data, so I'm not going to repeat everything that I did in that earlier show, but I'll just give you the headline. Then what I'm going to do is to go through some of the maps, because I've got some mapping tools that I can show you with regard to what's going on with the particular distribution. I think the maps are a very good way of looking at what's going on. And then what I'm going to do is to look at individual postcodes and households, and from there we can answer some questions about some of the particular postcodes that people would like to look at. So that's how I'm going to play it. I'm going to be looking at the chat from time to time, but not necessarily through this time part of the chat, simply because of the show, I should say, because I can't look at two things at once, and I've got to try and focus on what I'm doing. So let me just go back to the mortgage stress and just remind you that what we do is we use our core market model to make this analysis. We run surveys. Those come in every week, and we do this then analysis each month. And we can slice and dice the data, as I said many times, in multiple directions using a Rubik's Cube methodology, turning it in different directions. We can also then think about what the scenarios might be like for the future. And we put all the information, the mortgage stress information, the price trajectory, the buying and selling intentions, the migration data, the broader economic information into the core market model, whack through the scenarios, and that allows us then to look at the postcode level, regional, state or Australia level, and we can also make some scenario suggestions as to where the scenarios may be ahead, and I'll talk about the scenarios shortly. And I will just mention here, as I often do, that we do provide a one-to-one service if you want to have a more detailed conversation about an individual area. We can do that. We can look at the trends. It's not financial advice, of course, but we can look at the stress data, the home price data, and perhaps think about what may be happening ahead. And we can do that via Zoom or a phone call, about an hour at a time. We are taking forward orders at the moment. There is a cost involved, simply because there's a lot of research to be done to make it happen. And we're booking 3 to 5 weeks out. And if you'd like more information about that, you can go to the blog. The details are below there, and you can arrange a time with me. Quite a few people are interested in some of the latest analysis because, of course, there are so many moving parts at the moment. Now, just on mortgage stress, let me just come back to the definition. This is really important because, of course, there are many different definitions of mortgage stress. And what I find quite often is that we get people confusing my definition of mortgage stress from, for example, 30% of income, which was a very old-fashioned way of doing it, or in my view, or looking at taxable income, or looking at underwriting models such as the banks might use, but I use it a different way. I use cash flow as the fundamental definition of the way that stress works. And cash flow, of course, is money in, money out. And that's quite important in my view, because it gives us a real sense of where people are in terms of their cash flow. So if households have more outgoings, excluding one-off discretionary items than income, we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, then in rental stress. But it's cash flow, which means they're not necessarily going to fall over tomorrow afternoon, but it does mean they've got an issue. They might tap onto their savings if they've got those, put more on credit or whatever. But it is a cash flow measure. If we look at property investors, we look at cash flow pressures, and if they are stressed investors, that means they've got cash flow pressures. So that's often to do with the mortgage repayments. And we can also look at total financial stress, which is an aggregation of the various dimensions we look at. And we can look at it as a percentage of households and counts. I think the latter, the count, is a better measure of what's going on. That's what I tend to use. Now, here is the high-level summary of mortgage stress in July 2023. We're going to start with rental stress first, and you can see that the rental stress is massively high. It's as high as it's ever been, more than 68% of households, and that's a big deal. And it sort of charms all the other research that's out there that renters are really up against it at the moment. Mortgage stress is also rising though, and it's closing now in on half of households, and that's a pretty frightening number, up from just over 32% before COVID, and you can see the significant acceleration there. And by the way, the RBA also highlights the fact that the debt-to-income ratio is pretty high. Of course, it's a little bit weird because they talk about all households when only a third of households have a mortgage. So the real story is probably significantly worse than their data. And here is the overall summary for the last month, broken down by the individual states. And you can see there, firstly, that I've highlighted the increase from last month, and pretty much everything has gone up, other than mortgage stress in Canberra and a little bit in the Northern Territories, and pretty much everything else going up. So that's a big problem. Sorry, I said Tasmania, it should be. So investors in Tasmania are still able to put the rents up more than the mortgage. So that's why the mortgage stress there is down a little. But pretty much everything else, it's pretty bad. Now, what I thought I'd do is to then move now to my other screen. And to do that, I just need to push a couple of buttons. So hang on a second. I just need to switch this across so I can then show you the... Okay. So this is the mapping, which happened to be for Sydney, which is the one that I had loaded first. This is mortgage stress. And on these sorts of maps, as you may know if you've been following it, the reds are the most severely stressed parts, and the blue are the least stressed parts. So you can see here in this particular one, there's Liverpool here, around 2170, and here's Campbelltown, which is highly stressed, and 2570 if you go out further into places like Harrington Park and Camden. That's all pretty bad. If you come in closer to Sydney, you can see there the areas around Canterbury and Bankston and Fairfield and Parramatta are also somewhat stressed, but not as badly stressed. And then as you come into the centre of Sydney, you can see that things are not too bad closer in. But there are still some hot spots. So Randwick is one I keep watching. Also Roselands and places like that. Homebush Bay. And if you go up towards Parramatta and Ryde, again, you can see the same sorts of pressures that are actually emerging. South Wentworth is there as well. And Lane Cove. And even places like Mossman, which you may be surprised about. But of course, Mossman is very affluent, but it's also quite leveraged. And if we go up to the northern beaches, we can also see issues there as well. There's perhaps no surprise to places like DY and Curl. And even if you go further north up towards the mid-north coast, central coast, places like Gosford and areas of there are also in some degree of difficulty too. And so this is a bit of a flavour. Now, what we find often with these sorts of charts is that there's a correlation between high stress and cash flow, of course, but also high stress and lots of new building. And if I show you an alternative view, let's go down to Melbourne and to Victoria, postcode 3000 we'll focus in on first, and then we'll drill out from there. And so if I come into the Melbourne equivalent of these maps, and you can see as we drill out that closer in to the centre of Melbourne, there are some warm spots, Essendon, Moreland, but you start seeing these much more severe areas as we pull out here over to like Hoppers Crossing, for example. And if we continue that same journey, we can actually see areas in and around Melbourne to the north, to the east, and to the west. Narrow Warren here, for example, and places like that. And if we pull out slightly further, we can see that there is quite a considerable distribution, even as far out as places like Ballarat, which shows quite high levels of stress too. So it's this sort of circle. Now, one of the characteristics of this circle, and I call these the high growth corridors. So there is a lot of new development, a lot of home and land packages, a lot of people who bought relatively recently, a lot of migrants who've moved in. For example, areas around Point Cook is a good example of that. And so you've got all of these factors driving significant levels of stress. So I talk about high growth corridors quite often, simply because people have bought homeland packages. And of course, remember Home Builder was offering very cheap deals. A lot of people were using the first buyer incentives to be able to get in as well. So everything was significant. As Vanessa says, I'm watching Ballarat closely. Yes, I think that's right. I'm watching this area around here quite closely. There's a lot going on, a real lot going on. Now, what I will then do is I will go through just a few of the other ones, because I often get people saying, well, you only talk about Brisbane and Sydney and Melbourne. So I'm going to go beyond that. I'm going to go now to Brisbane first. And again, we'll look at the story from the centre of Brisbane and drill out. Now, of course, the household counts here are not as high because the population density is lower. So we don't necessarily see so many red postcodes. There are some. But you can see as we pull out from the centre of Brisbane, once again, in and around the centre of Brisbane, not too much. But as you pull out, Camp Hill, for example, just let that load. Apsley, places like that to the north. And then we come over to the west to Ipswich. Ipswich is a big area of concern. I'm watching a lot of issues there in the greater Ipswich area. And as we pull out, even if we go north and south, we start seeing some interesting issues in the Gold Coast if we go south, or if we go up north of Brisbane as well, on the Sunshine Coast, there are some issues. Now, not necessarily red, but if I take the Gold Coast as an example, you can see that there are quite significant areas where the numbers in difficulty are quite high. But I'd want to highlight again this area around here, which is of course including Ipswich and other areas too, is where a lot of the pressure is. And if you look in again, a lot of building was done recently, a lot of high growth corridors, a lot of properties banged in together with big mortgages. So it's pretty much the same story wherever you go. And I will just go up to the Sunshine Coast a bit higher up there. And you can see that some of the other, so like Mango Hill and places like that. And if we just go up slightly more. So I have this mapping for every postcode, of course, in the country. And it certainly is quite interesting. Now, if you look here around Noosaville and Sunrise Beach and Noosa itself, you know, there's a bit, not a lot, but a bit. But if you come in behind that into places like Rosemont, then the stress counts get quite a lot higher. Now, if I then go to 5,000, so this is now centering in on Adelaide. And once again, we'll do the same trick of pulling out and seeing where things are. And again, the population distribution is lower, so therefore the number of red postcodes is lower, but we should be looking at the yellows. And it's interesting that if you pull out, you start to see that in the centre of Adelaide, not too much. But if you go to the north, there's definitely some stuff going on there. If you go south, there's some stuff going on there. And there's a Campbelltown there as well with some interesting coloration as well. And if we go up to Salisbury in the north, you can see that's continued to be a high stressed area, and there's a bunch of demographics going on there as well as some significant growth. And if we drop down south a little bit, you can see that it's a little bit less of an issue coming away from some of those high growth corridors. But Mount Barker is showing a considerable issue, and that of course is again to do with demographics. Now if I then go to 6,000, so this is central Perth, and it's a pretty similar story where in fact in and around the centre of Perth there are some areas where things are pretty good. West Leverville not too bad at all, but if you actually then come out, you then start to see the yellow start to show. If you go north of Perth or south of Perth, South Perth itself, and if you come out further than that, you then start to see some of the other areas like Westminster or Hilton. And if we draw out the map a little further, you start to see some of the more significant areas. 6065 Wangaroo, one I've been highlighting for quite some time. Massive amounts of development there on the coast, Joondalup and places like that. And again, it's high growth corridor. It's a lot of new properties, a lot of people highly mortgaged. I also want to highlight this, that if you look at this swathe here from Cockburn through to Armidale, there's a lot there south of Perth. And again, that's a lot of new development as well as a lot of demographic forces. And if you come down to places like Mandurah, well, even there, the story is still pretty stressed, despite the fact that some people are claiming that Mandurah is recovering. My data suggests something rather different, as I'm seeing it there. So that's the story in the west. And then if we go to 7,000 around Hobart, and once again you see the same sort of story. Here is some areas in and around Hobart, and you can see there that 7,000 is not looking too bad, but if you go slightly north up towards Derwent Park, there's more stress. If you go around here on the other side of the peninsula around Mornington, you've got some issues there as well. And if you pull out, you can see, now again, the population density is much lower, of course, than other areas. But one of the things that I observe is that mortgage stress, as on a percentage basis, is highest in and around the areas of Tasmania. And that's because, of course, we have massive run-ups of prices, wages growth is pretty limited, and the income to rent trajectory is not looking pretty flash. And I could go up, I won't, but I could go up to the northern parts of Tasmania and also show you situations there. So hopefully that mapping gives you a bit of a flavour of what's going on. I can do the same for the rental as well, and I can do the same for the financial stress, but it's a somewhat similar story. So high growth corridors, areas where you've got considerable amounts of new development, highly leveraged households, people working often multiple jobs, people often working multiple part-time jobs to try and get by. So it's a big deal. Now let me just set this back so I can show the chat again. Okay, and if I then come back to that one there, no, that one there, yeah. So the next thing I'm going to do is I'm going to go back to the other computer, and one of the things that I can do is then show you the information at an individual postcode level. And so this is the standard report that we produce for each postcode. And what's interesting about this is it gives you a very good flavour of all the things that are going on in this particular area. And this is the one I've picked quite often because it's an area I know very well, Wollongong. And I just want to talk you through the format, and then we might look at a few other postcodes. I've got a few people asking for quite a few, so we'll try and add some of those in as well. And you hear the dogs in the background, they're sort of wobbling about, making quite a lot of noise at the moment. Okay, so postcode 2500. First thing to notice, the household count, so 18,900, and it's split between owning outright, borrowing, and renting. And so 49% of people in this postcode are renting, 25% are borrowing, and that gives you the relative distribution. I've also included the suburbs simply because the postcode is more than one suburb quite often. And then we look at the number of borrowers in mortgage stress, so 41%, 1,900. Those in rental stress, 73%. So rental stress is a real issue in this particular area. Stressed investors, and the overall aggregate for financial stress for households if I aggregate it up. And I should make the point that I shade it over certain levels just to highlight particular problems. Then we've got some information from the census in terms of splits of houses and units. And you can see here that in this particular postcode, 35% of houses, 52% of units, 11% of other types. That includes living over shops, and it even includes temporary accommodation, caravans, and those sorts of things too. Then if we look at the people ratio, so how many people for households versus houses or units, in other words, residential units, and it's 2. So that's an interesting, and we'll see that varying from postcode to postcode. What proportion was vacant on census night? So 9.8% was vacant, more than 1,900. And then we've got data on gross investment yields and net investment yields. Gross investment yields is the relative rent versus the cost of the property. Net investment yield is the true return for an investor after taking account of the various costs of actually running the property, paying the interest on the mortgage and all of those things, as well as repairs and maintenance and management fees. And then we go around here and look at the taxable income. This is from the ATO, so 79,000 per household on average, or from the census, 84,000. It does vary because it's calculated differently. And then we finally come back around here to look at the disposable monthly income. So for those borrowing, around 43% of the disposable monthly income are going on the mortgage, more than $2,400. It's gone up a lot. And for those renting, about 35%, 1,993, 49% of income. 49% of households have 35% of their income going on paying the rent. And then the final part of the puzzle is my scenarios. Now I'll come back to those scenarios and what's driving them in just a second. But let me just make the point that the story here is that the scenarios ahead, this is a cumulative view of 12, 24 and 36 months. And I've got a best case, a base case and the worst case scenario. And I have it for houses and units, and that we've also charted them so you can see the variations. Now let me just go back and talk briefly about the scenarios, because of course the scenarios are quite important in terms of actually understanding what we think about may be going on at the moment. And let me just put that there. So the scenarios are just a way of exploring different futures and to consider the consequences. It's not a forecast, but it's to facilitate some understanding and debate. None of these scenarios may be right, things change. We do use a framework driven from our core market model, and we're going to look at those 3 potential outcomes updated with the latest data, and the scenarios run forward from today. And here are the 3. So the best scenario, I've called it the Goldilocks zone, is that we don't get any further rate rises. They're at 4.1, and then full next year. Inflation eases ahead of RBA expectations. Wages rise faster, and there's no recession in Australia. So that's pretty much the best possible that we could have. The base case is what I call a soft landing. So rates go slightly higher, 4.35%, which means mortgage rates go up a bit more, 6.75 to 7.5%. They stay high through 23 into 24, while inflation stays above target until 25. But no recession in Australia. And what I call the nightmare, the worst case scenario, this is where we see rates rise. So mortgage rates would be above 4.35%. Cash rate will be above 4.35%. Mortgage rates at 7.5 or more. They will stay high through 24, along with inflation. So inflation stays sticky. Wages growth starts to stall, and we start getting a recession. They then cut rates, but it's probably too little too late, and then things go from bad to worse. So that's the sort of range of scenarios that I'm seeing at the moment. And those are the scenarios that I've then plugged into my model And what you'll see is that it's sensitized, meaning that those areas where there is high levels of mortgage stress tend to see predicted bigger falls in our scenarios. That may not happen, but that's what I'm seeing at the moment. Okay, so with that out the way, I'm just going to answer a couple of ones that were in the pre-show. So I got a request for 4560, so let me just try and put that in the system. Okay, so this is Nambour in Brisbane and Moreton. And you can see here that we've got 14,000 households in the area. We've got 30% owning outright, 43% borrowing, so that's a mortgage issue, 25% renting. And at the moment, we've got 54% of borrowers in mortgage stress, 88% in rental stress, not much stressed investors, and we've got 53% of households in financial stress. Looking at the mix, 79% of properties in the area houses, 5% units, 15% other types. Population ratios, people ratios, 2.34, so that's slightly higher, more families. Vacancy rate was 5.4. The gross investment yield is 4.6, which may sound good. Net investment yield is positive, 0.7%. Well, I suppose at least it's positive. Average taxable income, 67,000 for the ATO. That's per individual, or per household, 73,000. And if I then translate that to the mortgage, 44.9% of disposable income on average going to pay the mortgage, more than $2,000. And the average rent is 40%, $1,869. And on the scenarios, well, even on the best scenario, I'm seeing a slight slide in prices over the next 3 years. So cumulative maybe down 7%. The worst case, of course, would be significantly worse than that. So that's that one. I'm going to do 3121. Again, one that was on the list before we started. And then I'll come back and look at the chat and pick up on the conversation. So this is Richmond in Victoria with 15,000 households there. Only 16% own outright, 27% have a mortgage, but 55% are renting. And the monthly disposable income's around $7,000, with 35% of the income going on the mortgage and 28% going on the rent. Now, if I look at the stress, 61% are in mortgage stress of those with a mortgage, 68% in rental stress. The stressed investors is at 35%, and the households in financial stress are at 64.9%. 15% are houses, 52% are units, and 32% are other types of property. The people ratio is much lower, so this is more individuals rather than lots of families. 15% were vacant on census night, and that could be some second homes, it could be some rental property that wasn't let at the time. Gross investment yields 4, net investment yield 0.7. Average taxable income is higher than the last one we looked at, with the individual taxable income around $102,000 and the household at $118,000. And then if we look at the scenarios, there's, even the best case, a bit of a fall on houses, a slightly smaller fall on units over the next 3 years. The base case and worst case is considerably worse. Okay, so that's given you a bit of a flavour of what we can see. Now what I'm going to do is go back over the chat a bit and just see what else is people saying and see whether we can look at what's going on there. And let's just put that back up. Thanks for the detailed info. Yeah, I mean, I think that's a really important point. I tried to go granular here because I think it's very important to really look at the individual areas rather than talk in aggregate. And I get a bit cross with the conversations about property prices in Sydney did this or in Melbourne did that. You know, there are very significant differences, very, very significant differences in different places. And the fact is that, like it or not, different households have different dynamics. Now, Bossman TV said 4510. Let me see whether I can put that in the system for you, 4510. To do that, I have to go here. Okay, so 4510 is Caboolture, Brisbane and Moreton, 20,000 households, 23% own outright, 38% are borrowing, 38% are renting. Looking at the mortgage stress, only 13% are in mortgage stress. That's pretty good, but rental stress is very high, 88%. Stressed investors, 33%, so overall financial stress, 46%. Most of the properties are houses in the area. There are some units and some other types of property. The people ratio is 2.43, so that's suggesting some households rather than just individuals. And the vacancy rate was 6.9%. Gross investment yield of 4.6%. Net investment yield is 0.8%, so it's pretty low. And I think I want to highlight that. A lot of the property investors are basically banking on capital appreciation because they know they don't get much from cash flow. You'll see at some other postcodes where it's actually negative. Individual ATO income, 62,000. Household census data, 68,000 for the income. And that translates to 42.9% of disposable income going on the mortgage, $1,900, or 36.5% going on the rent. And looking at the scenarios, there's a small fall over the next year or two or three. In fact, a small fall next year, and then it pretty much stays. And the best case scenario for houses, units even less of a move. But of course, if the base or worst case scenarios come out, then expect more of a fall. Okay, so the next one that I'm seeing there is from Sandra. She's asking for 2722. Sorry, 3722. I can't read. Okay, so this is Mansfield, 3722. Now this is a smaller postcode with a smaller proportion. And so I've got to be a little bit cautious with low counts. When it drops below a certain level, you'll see a low count flag, but it hasn't quite reached that. But anyway, 42% own outright, 35% borrowing, 21% are renting. Of those borrowings, 60% are actually in mortgage stress. 25% of renters are in rental stress. Only a very small proportion of investors are having difficulty. And overall financial stress, 27%. Most of them are properties here on houses, 93%. Small number of units and other types. People ratio is quite on the lower side, so it tends to suggest smaller households. High vacancies, 15.8% on census night. Gross investment yield, 3.2. The net investment yield, though, is negative, minus 0.9%. So most investors are underwater if they're fully maintaining their property. Looking at the taxable income, 68,000 for the ATO, 70,000 for the household census. And that translates to 40.9% going on the mortgage, 1,900, or 35%, 1,600 going on the average rent for this particular postcode. And looking at the scenarios, you can see there's a small drift down, best case scenario over the next 3 years. In fact, 5 down and then a bit of an up in year 3. The base and worst case, more significant falls. Okay, if I go down the list again, Sandra says 3722 for living, not investment. Yeah, I've always said, it's an interesting observation, but people, if they're looking for an investment, have to have a different logic for if you're actually going to buy for living somewhere. Because the main thing about living in a property is the fact it gives you utility. It gives you somewhere to live. And, even if property prices don't necessarily always go up, they don't always go up, of course. You've seen that in recent times. If you're living in the property, then it's one set of logic. If you're investing, it's a different set of logic. Unfortunately, what I see quite often is that property investors have this sort of, rate of return logic, which may make some sense, and that's why some people are actually listing their property investments now for sale because they can't make the return. But if you apply that investment logic for an owner-occupier purchase, I think you often make mistakes. So it's very important to differentiate for owner-occupation versus investment, in my view. Now, other people might disagree, but that's one of those things. Okay, Ben has asked for postcode 2067. So we'll try and put that in. To 6.7. So that's Chatswood in Sydney. That's going to be that one. It's going to be that one. I'll push the wrong. Sorry, I must push the right button or I don't get the right result. Try that. I've got too many buttons. I relayed all of my buttons out when I changed the studio, and I'm still learning my way around the buttons. Okay, so this is Chatswood in Sydney, 10,600 households with 26% owning outright, 23% borrowing, and 49% renting. Mortgage stress isn't an issue. Rental stress is at 66%. Stressed investors are a thing, 50%. And overall financial stress, 52%. That translates to a bit of a fall in prices. Best case for houses down maybe 8% over 3 years. For units, down slightly less. If I look at the mix of property, 31% are houses, but 64% are units, 4.5% other types. The people ratio is 2.26. The vacancy rate's 11%. Gross investment yield's 3.6. Net investment yield is just pretty much 0. And you can see here the average taxable income, 105. Household census, 113. And that means that 53% of borrowing, 53% of income is going to pay the mortgage. That's really high. That's more than half of people's income. But I am seeing this in a number of postcodes now. So we're seeing quite a few postcodes where people are putting more than half of their income for somewhere to live. It's remarkably high and very painful. 42.6% for those renting. So if I go down my chat and see what else is being there. Okay, it's Jump for Joy said in my area, Mullaloo 6027. So let's put that one in. I should explain that I did have 2 mice when I moved, but one of the mice don't work at the moment, so I can't do things quite as efficiently as I sometimes do. But anyway, that means I can't show the chat when I'm actually showing the analysis here. 6027, which includes Ocean Reef, Belden, Connolly, Edgewater, etc. This is including, of course, Joondalup, which I mentioned previously. 16,000 households there. 28% own outright, 48% are borrowing, 22% are renting. Excuse me, let's take a drink. 43% in mortgage stress for those borrowing, 76% for those in rental stress, 22% for stressed investors, and households in financial stress, 44.8%. Now, looking at the scenarios, best case scenario is a small fall of just a couple of percent over 3 years. The base case is a more considerable fall for houses, slightly less for units. If I look at the mix, 85% are houses, 5.6% are units, a few other types as well. The people ratio is 2.39, so some families there, but small families. On average, vacancy rate was 6.4%. Gross investment yield's 4.3, net investment yield 0.4. The taxable income, 84,000 for the individual, 104,000 for the household. And that means that 39% of the disposable income is going on the average mortgage payment, $2,400. 30.7%, $1,894, going on the average rent. Okay, so that's that one. George Double says 2256. He says YY in the Central Coast, 7,200 households, 34% own outright, 30% borrowing, 35% renting. And here we've got 19% in mortgage stress, 92% in rental stress, some stressed investors, and overall financial stress at 42.9%. We've got 69% of properties being houses, 5.4% being units, and 25% being other types of property. We've got a people ratio of 1.92%, so that's lower. Vacancy rate was 13%. Gross investment yield was 3.4%. Net investment yield is minus 0.5%. Individual ATO income 76,000. Household census 67,000. As a result of all that, 56.5% going on the average mortgage repayment, more than $2,400, and 44.6% go on the average rent at $1,894. Okay, let's go down the list. MCM says 3056. This is Brunswick in Victoria. And here we have 11,700 households. 21% own outright, 29% are borrowing, 49% are renting, and 48% are in mortgage stress, 71% in rental stress, 40% in investor stress, and financial stress is 59%. It's pretty high. As a result of that, more significant fall, maybe 11% over 3 years for houses on the best case scenario, units down 9%. And talking of houses, 35% are houses, 34% are units, 30% are other types of property. People ratio is lower, 1.85, so that includes more individuals and smaller households. And the vacancies were 12.5% on census night, which is quite high. Gross investment yield 3.2%. Net investment yield, after all the costs, minus 0.7%. No surprise then that stressed investors are actually struggling. And if we look at the individual ATO, 83,000, individual household census data, 108,000, giving disposable income 36.6% for the average mortgage, payment 2,587 or 31%, 2,198 for the average mortgage, rent, I should say. Okay. Let's go down the list a bit further. Jason says, cheers once again. Can you spare a few moments for Mossman, Queensland? 4873. We'll do that one first. $4873. There you go. Now, make sure I got that right. 4873. Yeah. Low postcode count 2710. 36% own outright. 35% are borrowing. 27.5% are renting. Mortgage stress of 50%. Expectations are that scenarios are best case small rise over 3 years for houses and for units. Most of them are houses in the area, and we've got a high vacancy rate, so a lot of those will be holiday homes and roulettes, I suspect, Airbnb, those sorts of things. 15.8% vacant. 4.4% from the gross investment yield. Net investment yield positive, just 0.2%. And looking at the percentage, 42.1% goes on the mortgage payment, that's disposable income, 31% going on the rent, and that's based on 62,000 individual ATO for taxable income, or 63,000 for the ABS. Now, you also asked about Port Douglas, 4877, so we'll do that one. Again, a relatively low count. 29% own outright, 33% of borrowing, 37% of renting, 45% in mortgage stress, and again, a small uptick, 2.7 and 2.4% over 3 years is the expectation. 52% are houses, 19% are units, and lots of other types too. 21% were vacant, again, Airbnb and rentals and holiday homes, part of the story there. Gross investment yield 4.4, net investment yield 1%. Average ATO income 58,000. Average household 74,000. 42% going on the average mortgage. 37% of disposable income going on the average rent. And then you also asked about Cairns 4870. I need to get my other mouse working. It'll be a lot easier. Oops. Yeah, 4870. Cairns, yep. 4870. 28,000 households here. 21% are outright, 35% are borrowing, 42% are renting, 46% are in mortgage stress, 27% in rental stress, and not much investor stress. 59% are houses, 25% are units. People ratios 2.11. 10% were vacant, that includes Airbnb and all of those things, and holiday homes. Gross investment yield 4.3, net investment yield 0.4. Average disposable income based off 74,000 for the ATO and 78,000 for the census means that 37.7% or 1,920 goes on the average mortgage and 1,554 at 30% going on the average rent. Okay, what else have we got? GB Northern says 4670. 670, which is Millbank in Queensland, and they're 34,700 households. 37% are owning outright, 32% are borrowing, and 30% are renting. The scenario is that 21% have mortgage stress, 73% have rental stress, a bit of investor stress, overall financial stress 38%. So scenarios are a small drift lower over 3 years, best case scenario for houses, and for units, a more significant fall in other scenarios. 83% are houses, 6.8% are units, 9% are other types. People ratio is 2.1. There's around 3,000 or 8.4% vacant. That includes, I suspect, a lot of rental property and those sorts of things there, maybe even second properties. 4.6% the gross investment yield, positive 0.9% net investment yield, and 70,000 with the ATO, 62,000 from the census, translates to 39% of disposable income, or 1,560 going on the mortgage, 35.5% going on the disposable income for rent, 1,420. Okay. Sandra says, thanks for doing 3722. You're very welcome. Okay. Sam says, can I do 2234? Can do. This is Alford's Point in Sydney with 10,000 households. 39.6% own outright, 50% are borrowing, 9.9% are renting, 65.3% have mortgage stress, 87% rental stress, a bit of investor stress too. More than half of households are in financial stress in that postcode. Therefore, a bit of down scenario, even the best case scenario for houses, down 13% over 3 years or 12% for units over 3 years. And looking at the breakout, 86% are houses, very small proportion are units. People ratio is higher at 2.97, so that's more families. Much lower vacancy rates, 2.7%. Gross investment yield is 3.4. Net investment yield is minus 0.2%. Taxable income, 93,000. Household, 142,000. And that translates to an average mortgage repayment of $3,240 a month, or 41.9%. Average rent at 38.6 or 2,990. Okay, where do we go next? BJC says 5119. Sorry, 5118. I can't read. Oh dear. Need to change my glasses. 7,000 households. This is in Gol East. 28.9% own outright, 48.6% of borrowing, and 22.5%. And there's no stress. Pretty good. And looking at the story here, 85% are actually houses, very small number of units. The people ratio is 2.29, and the vacancy rate 6.1. I haven't got any gross investment yield data on that particular postcode, I'm afraid, so sorry about that. But I have got the disposable income, 70,000. Meteor's making squeaking noises. Hello, what are you squeaking for? 70,000 and 77,000. And that means that 29% are going on the mortgage and 23%. So this is a postcode where things are looking pretty good, and therefore, in the best case scenario, prices could grow quite strongly, particularly 2 or 3 years down the track. Although, of course, in the base case or worst case scenario, it's more of a slide. Okay, let's have another look at the story. What else have we got? And that one. 4053. That's from Steve. So this is McDowell in Brisbane with 19,000 households. 23% are owning outright, 40% are borrowing, and 36% are renting. I've got 46% in mortgage stress, 68% in rental stress, a bit of stressed investors as well. Excuse me 1 second, I think the dogs need a little bit of a... What's going on, Gil? I'm going to drink. There you go. Here you go. Sorry, I let the dogs out. I need to go and get a drink. Yeah, we're interested in what's going on outside. Hello, there you go. Okay. Sorry about that. Doggies. Yes, that's right. Where was I? 4053. Okay, so 46, 68, 23 and 48. So 48% in financial stress. And we've got small falls over the best case scenario for houses and units. A bit more of a significant fall for others. 76% in this area are houses, 11% are units, 12% are other types of property. The vacancy rate's 5.6%, just 1,000. Gross investment yield is 4.5, net investment yield 1.2. Here's the income, 83,000 for the ATO or 111,000 for the census, which gives us 36.7% of disposable income, or 2,476 going on the mortgage, or 30% at just over $2,000 going on the average rent. Okay, 4053. Otto says 2204. Yeah, when you give me a list, I'm not sure I can do them all, simply because it takes too long. But I'll do certainly 2204 to start with. See how we go. All right, this is Marrickville, so into Sydney here. The counts 11,000. 21% are owning outright. 30% are borrowing. 47% are in rent. 23% in mortgage stress. 84% in rental stress. Rental stress is a thing, and of course that translates to stressed investors as well. And the financial stress is 58. As a result of that, the expectation is that slides in value, even best case scenario, are likely for houses and units. 32% are houses, 47% are units, 20% other types. People ratio is 2.11. 9% were vacant, just over 1,000. 3.4% gross investment yield. Net investment yield is 0.2. And that translates through 89,000 from the ATO, 112,000 from the census, which gives us 44.9% of disposable income, which is remember 30.6% of households being hit by that, but 34.5% of the 47.5% of households, 2,392. And Otto, you also asked about 2206, so I'll put that one as well. That's Earlwood, with 7,000 households, 41% owning outright, 36% borrowing, 21% renting, with 27% in mortgage stress, 78% in rental stress, much lower levels of financial stress. As a result of that, a bit of a fall, but not so much of a fall for best case scenario for houses and units for the 3-year period. 79% are houses, 10% are units. The people ratio is 2.66, so it's a higher ratio. That's more households with families. 6.2% are vacant. Gross investment yield 3.5, net investment yield minus 0.1. The ATO data is 91,000. The census data is 111,000, which gives us 52.4% of disposable income going on the typical mortgage repayment at 3,360 and 42.7% at 2,740 going on the average rent, which are pretty extreme, frankly. And Otto, you also asked me for 2153, which I will do, and then I need to move on. This is Balcombe Hills, so 21,000. 31% own outright, 47% are borrowing, high mortgage belt, 21% are renting, 34% in mortgage stress, a lot of rental stress, some investor stress, 44%, and that gives us a bit of a slide, even best case scenario over the next 3 years for the value of houses and units. 75% of units, 75% of houses, 13% of units. The people ratio is 2.79. 5.5% are vacant, and 3.5% gross investment yield, 0.2% minus, so a loss for typical net investment. 94,000 on the income from the ATO, 129,000 from the census, which gives us 45.4%, or $3,311 per month for the average mortgage repayment, or 36.9% at $2,691 the average rent. Okay. The quote says 2132. There you go. 2132 Croydon, New South Wales. So lowish count 3912, 33% own outright, 35% are borrowing, 31% are renting. A third are in mortgage stress. Pretty much everybody who's renting is in rental stress. That's putting pressure on the investors there, and overall financial stress is 53%. Scenarios are down 13% over 3 years, best case scenario for houses and 11% for units. 55% of houses, 27% of units, some other types of property too. And the vacancy rate's 5.8%. Gross investment yields 3.6, net investment yield minus 0.9. Income 90,000 from the ATO, 112,000 from the census, giving 44.3% disposable income for the for the mortgage, I should say, and 32.7% or $2,392 a month for the average rent. Ben's back again with another one. 4141. Oh, which I don't have data on. Sorry, can't do that one. 4114. Try that one then. Yes, that's Woodridge in Queensland. 9,978, with 70% owning outright, 23% borrowing, 59% are renting, giving us 42% in mortgage stress, 77% in rental stress, some stressed investors too, and the households in financial stress at 67.6%. Bit of a fall over the next 3 years on the best case scenario for both houses and units. Hello, making squeaks at me. The dogs are thinking I've gone on long enough. I know, just a bit longer. It's all right. 69% of houses, 5.5% of units, and looking at the people ratios, 2.59%. Vacancy rates, 8%. Gross investment yields, 4.6%. Net investment yield of 1%. Looking at the income, 54 from the ATO, 56,000 from the census, giving 40% for the average mortgage repayment at 1560 and 37.8% for the average renter, 1446. So there you go. Alex said, why does Westpac claim only house prices increase? Well, I'm not sure that I've got the full story on that, insofar that if I look at the data from both CoreLogic and elsewhere, you can see that there has been some differential movement in different types of houses in different places. I think that these aggregate stories don't really tell much of the story. So that doesn't necessarily, I think, give the full story. On the other hand, of course, Westpac is quite keen to encourage everybody to believe that the property market's doing fine because their losses will be low. So when the banks are talking about the property market and loss rates and those sorts of things, remember they have an agenda, and that's to show that they've got very low levels of delinquency and default. So that may have something to do with it, but I don't really have a full answer to your question. It's certainly, you need to go granular to understand what's going on in terms of individual properties and how they're moving about. Now, Drew said 3008. Hi, Drew. Let me try and get the mouse back there. I'll get my other mouse working for next time. Docklands in Melbourne. Oh, very interesting one. Let me put the slides back up. Okay. So 8,000 households. 10% own outright, 20% are borrowing, 67% are renting. 43% are in mortgage stress, 67% are in rental stress, 60% are stressed investors, not a good investment, and 73% of households are in financial stress. As a result, significant falls over the next 3 years, down maybe 12% for houses in the best case scenario, 10% for units. Worst case scenarios, of course, more significant. And of course, the mix of property here is 97.8% are units, almost no houses. 24.3% were vacant. This vacant issue here in this postcode is massive. I believe there are a lot of people sitting on vacant property, not letting it out in this area. And certainly the census data underscores that. 4.1% gross investment yield, no returns from a net investment yield perspective. And the average taxable income, 94,000 from the ATO, 101,000 from the census, giving 34.8% the average disposable monthly income at $2,400 for the mortgage and 29.7% for the average rent. And again, I highlight the fact that here a lot of vacant property is definitely going on. There's a problem here, and not only here but other places too. A lot of foreigners holding property vacant. A lot of short-term lets and Airbnbs is part of the problem too. It doesn't help with accessibility. Okay. 3008. Is that Pentridge Prison, said George. I don't think so, but it could almost be, couldn't it? 3073 says MCM. This is Reservoir in Victoria with 21,400 households there, 29.9% owning outright, 32% borrowing, 37% renting, 71% in mortgage stress, 66% in rental stress, some investor stress, overall more than half of households in financial stress. And looking at the scenarios, a bit of a fall, best case on both houses and units over 3 years, 63% of houses, 3.9% of units, a lot of other types of property there in the area. People ratio is 2.17, the vacancy rate's 8.8%, and the gross investment yield is 3.2, with a net investment yield of minus 0.5. Average income from the ATO, 69,000, from the census, 80,000. And that gives us a 44.5% net disposable income payment of $2,383 a month on the mortgage, or 33.5%, $1,794 for the average rent. Okay, Russell says 2210. Lugano, which is to do with Rearwood, Peakhurst Heights and Peakhurst. Okay, postcode here is showing 12,300 households, 28% owning outright, 36% of borrowing and 35% of renting. And 22.2% are in mortgage stress, 90% in rental stress, 29.1% are stressed investors, and the household stress is 54.6%, giving a bit of a fall for houses and units over 3 years on our best case scenario. 57% of houses, 26% of units. People ratio is 2.53, the vacancy rate 6.1, gross investment yield 3.4%, net investment yield minus 0.2, and looking at the taxable income, 79,000 from the ATO, 87,000 from the census, giving an average monthly mortgage repayment of about $3,000 or 57.7%, and the average rental at 35.4% at $1,843. Cameron says Lugano is a great suburb. And Nick G says, so is the consensus the RBA rate hikes have almost reached their peak now? I think the truth is almost reach their peak is probably right, but they may have to go a bit higher. There's still a lot of stickiness to the inflation numbers. So if you look at what's happening with some of the latest numbers, I showed some of those at the start of the presentation, wages growth is easing back slightly rather than accelerating, so that might give them some leeway. I think the real question is whether they will do what they should do or whether they'll do what they want to do to protect the housing market. That's the key question. But even if they don't raise, the message I want to highlight is that rates will stay higher than they've been for a lot longer. And that means that we might see rates come down a little, but nevertheless, mortgage repayments will be a lot higher than they were a couple of years ago. And that's going to be the significant drag. That's what I'm seeing in my surveys. A lot of households can manage mortgage stress for a period of time. They can borrow on credit cards or use buy now, pay later, or use savings or whatever, or get a personal loan. But if it keeps grinding away and rates don't come down, that's a problem. Now, of course, the banks are going to do all they can to try and help people and restructure and refinance, all those things. But if rates stay high, or if the RBA puts rates up higher and then comes down again maybe a bit later, that's a problem. And of course, if the Fed continues to lift and if the Bank of England continues to lift, etc., that's going to put more upward pressure as well. So certainly is a significant. Okay. Vanessa's asking about vacancies. So I don't look at the water usage. There are people who do that. I'm looking at the vacancy rates as in the last census. So there was actually a specific number. Now, that's a point in time number. And of course, the further it goes on, the vacancy rates might change. There are other mechanisms that some people do use, including the water measurement, but that's not one I can have access to at the moment. Okay. So Michael Dunbar says 4090. Sorry, 5090. I can't read today. Don't know what's wrong. 5090. This is Hope Valley in South Australia. Let's put that one back up. Here we go. Okay, so this one has just 3,400 households, 34% own outright, 42% are borrowing, 20% are renting, 22.2% mortgage stress, 50% in rental stress, with some stressed investors. There's a potential for a rise in prices, best case scenario over 3 years, not so much with the base and worst case scenarios. 73% of houses, very small number of units. 2.14 is the people ratio, 5.5% is vacancy rate, 4.3% is gross investment yield, net investment yield is minus 0.1%. Average taxable income 64,000 or 66,000 from the census, giving us 43.2% of gross disposable income, 1820 or 37.9% at 1595 for the rent, which is still eye-stingingly high. Okay, just to ask you if you please like the post if you haven't done so yet. Pretty important that we help to get the algorithm to work for us, so please like the show and subscribe. Would appreciate that. This is a lot of work involved in putting all this information together and sharing it with you, so would appreciate your supporting it by subscribing and or please like the post. Now Jimmy says 2077. Which is Hornsby. 17,000 households, 21% own outright, 39% are borrowing, 39% are renting, with 34% in mortgage stress, 71% in rental stress, some investor stress too at 60%. That's going to put downward pressure on prices over the next 3 years for both houses and units, best case scenario. 39% of houses, 55% of units. 2.41 is the people ratio, so that's some families there. 6.6% vacant. Gross investment yield 3.5, net investment yield flat 0. 85,000 typical ATO income and 109,000 from the census, giving monthly disposable income 45% or 2,820. Disposable income to rent 36.6% or $2,290 per month. Okay, so we're pretty much coming up to the end of the show. So what I want to do is just pick up the presentation a little bit with just a few, if I may, other closing comments. And so the first thing I want to talk about is what do you do if you've got stress issues? I think this is a really important point because clearly I am seeing now quite a few households who are really struggling at the edges. And one of the things I want to highlight is the debt helpline here, 1-800-007-007. This is the government-backed helpline, and this is where you can get some advice. And I know they're very busy, but nevertheless, if you actually have financial flow pressures, it's really important to find someone to talk to. And whilst you can talk to the bank if you've got a mortgage, of course, the bank is going to give you advice that's going to help them, not necessarily help you. So it is quite important to get some advice. This helpline is one I would recommend. So 1-800-007-007. The second point I want to make is that, in my view, a lot of households are in difficulty and don't yet know it because they don't keep sufficient track of what's going on with income and expenditure. So the other thing I talk about is making sure that people have cash flows. So you know what's going on, what money is coming in, what money is going out. Then you can look at it and prioritize and make sure that you understand where it's going, because quite often people are surprised. Remember those old standing orders or direct debits or recurring repayments you put on your credit cards? Well, they'll go on being recurring unless you turn them off. The next thing to say is that we see in our surveys that people prioritize paying the mortgage and all the rent, and that's perfectly appropriate, bearing in mind that people want somewhere to live. But that means that quite often people are actually making compromise elsewhere. So, for example, cutting back on food, cutting back on medical expenses, and all those sorts of things, and also trying to work more hours. So, more part-time jobs, more hours in full-time jobs to try and help to get by. And that can certainly make a difference. If you have a mortgage and you actually are finding it difficult, the banks do have an obligation to assist. They have a hardship scheme. That hardship scheme is meant to help. What I'd say is quite often the banks will be able to help people who are not in too bad a position, particularly extending the mortgage or maybe going interest only for a period or maybe even forgoing payments for a period. But if you're actually right close to the edge, then it's more difficult for banks to help. So don't leave it to the last minute. If you do have issues with regard to making those mortgage repayments, then it is worth talking to the bank early. But as I say, it's very important to be armed, because if you don't go, you may end up being offered advice which will incur you more interest, which may actually mean that you've got a bigger problem down the track. And by the way, just restructuring your finances and pulling out more equity, which is what other people are doing, can help for a bit, but if you keep doing it, you end up with reducing your equity, of course. And there are people who now are coming to the point of realization that things have changed permanently with these higher interest rates. And whilst there will be some income growth, it won't be massively strong. And that means that people are going to have significant pressures into the future. And if we get a recession in Australia, which is certainly quite feasible with everything I'm seeing at the moment, that's going to put more downward pressure. Now, there are other people, of course, doing fine and who've got plenty of income and don't have any issues. But I'm focusing on those who actually have difficulty. And remember, in my stats, nearly half of households with mortgages have issues. And considering more of those have rental problems. Final point to say is that when people are actually thinking about switching rents, you can do that. And people are moving into lower rented areas. Of course, there's quite a lot of pressure and pain involved in doing that. And I've spoken to a number of people in my surveys who've had to move multiple times in the last year or two, and that incurs additional costs as well as additional pressures. And of course, it's quite hard to find rental accommodation as well. But there is a bit of a drift to the regions, as I showed earlier on, where people can't find stuff local in. Final point on the rents: significant demand for rental accommodation in apartments, which are actually a little cheaper than houses. And what I'm seeing is that some investors closer in are still able to yank the rentals up quite a lot. So make sure you read the rental agreements and understand what the consequences are. All right, so that's pretty much what I'm going to end with today. Let me just say that if you didn't get your postcode asked and answered on the stream tonight, and I apologize if I missed it, there was quite a few that I perhaps didn't get to, you can still send me a message via my DFA blog. The link is in the comments below. And if you then ask for a particular postcode, over the next few days I can send you that one-page sheet that is what I've been talking about today. And just give me a bit of time to turn it around, but that's available. I'd also make the point that if you want to get more information about what we do, you can, of course, look at the DFA blog, and the blog is there. It gives you quite a lot of information with regards to what's going on. And the thing about the blog is that it also keeps up to date with everything that we do, so you can track that and make sure that you're up to date. And of course, you can also support our work via Patreon. I really appreciate those who do. There's quite a few people who help. There are different schemes there. The one I want to highlight particularly is this one here. You can actually get the full data set that I've been going through tonight. It's available for 50 Aussie dollars plus GST a month. And that means and by the way, for those on Patreon, I'm going to send this out now after this show. If you want to look at all postcodes, you can get the underlying data and the summary sheet. And the underlying data contains quite a lot of additional information as well as the summary information I showed here. So that's available. And so if you'd like to go across to Patreon, you can sign up for as long as you like. I do appreciate that. It does help me to cover some of the costs from the surveys that I actually cover at the moment. And then the final point to make is that next week, again next Tuesday, Edwin is coming on because he and I are going to have a bit of a discussion about what's going on in the property market and answer some of the questions. We had a lot of questions being asked on Twitter and things like that. We want to cover some of those. So you've got questions for Edwin. Join me next week. The following week, I've got Veronica Morgan coming on to talk about particularly what's going on from a buyer's agent's perspective, and particularly in Sydney, which I think will be quite relevant. And the week after that, I've got Tony LeCantre coming back to talk about what he's seeing from his perspective over in the West. So that's what's going on. Anyway, I hope that was a useful conversation, and I hope that you found the various pieces of information I shared useful and relevant. As I say, if there's other ones you'd like to ask me about, send me a message. I want to say thank you very much for spending some time with me this evening. I will just go back to the doggy can where Luna is back now, curled up. Meteor is... I don't know where Meteor, she's gone. She went out to a drink and didn't come back, so there you go. But anyway, so that's the doggy cam. So thanks very much for spending some time with me tonight. Please like and subscribe if you haven't done so already, and check back next week. And also, of course, make sure that you check out the other shows that I put up, record and make. There's some new shows coming up which is going to cover some very important subjects, so keep an eye on that. and I look forward to seeing you this time next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.